So that is that for that one bit. Now, I know I just probably terrified you with this screen, but it's probably showing up in a pretty small font for you on a computer screen. But again, we have these periodic sort of summary tables that are designed to help students track what's been going on here, and it builds. So we started off on the left with the steps, and then in the middle are the fundamental issues, and then in the right are these special issues that we've been drilling down on. And just kind of walking through these, on the right, at the upper right in sort of light blue, we've got various criteria associated with when a contract exists. And then in the purple on the right, we've got examples of different kinds of contractual features that do or don't qualify as a performance obligation. In the middle, bright blue, that's where we've been. That's estimating the transaction price. And you can see there's the little bit of discussion of variable consideration, but we also have principal agent concerns, financing concerns for time value of money, payments of the seller to the customer. Step 4, that's where allocation of the transaction price comes into play. And the interesting issue in Part B here is, what if you don't sell this thing separately? How do you go about estimating it? And there are various methods that the ASU specifies. An adjusted market assessment approach, where you're basing it off what the market is and adjusting appropriately. An expected cost plus margin approach, so that's just what it is, cost plus a normal profit margin. Or the residual approach, where you calculate the standalone selling price of the thing you don't know by subtracting those that you do know from the total price. And those are all ways of coming up with a standalone selling price so that you can go through this allocation process.
Hey, Mark, just want to let you know 10 minutes.
Okay, great. Thanks, Dave. So then step 5, we've got recognizing revenue as appropriate. And again, the interesting issue here is that different kinds of contracts, different kinds of challenging circumstances. So the ASU deals a fair amount with licenses, and some licenses are viewed as transferring a right of use, so you can qualify for revenue recognition at a point in time. Other recognizing revenue over time, because you're really providing an access right that the seller is continually involved in. And then franchises, bill and hold, consignment, gift cards. So it's all in there. And when we put together this table, I just thought, as a student, I would so love this page, because if you really understand what's going on in this page, you really understand the lion's share of this standard. So I know I'm running out of time, but let me just mention what changed, okay? This is something that I think you might find useful as you're trying to adapt to this new standard. As I mentioned, we have an appendix in the chapter that talks about superseded GAAP, and at the start of that, we highlight some important things that differ between the previous GAAP and the new GAAP under the ASU. And we've already talked about a few of these. So we've got the first line here. What's the key concept? We're used to the realization principle. And now, instead, we've got the core revenue recognition principle that we've talked about. Second off, we got the role of collectability in determining whether revenue is recognized. In the previous GAAP, under the realization principle, we defer revenue recognition if cash collection isn't reasonably certain. And that would have us using the installment method or cost recovery method. These are sort of meat and potatoes parts of most intermediate accounting courses and intermediate accounting texts. Well, under the new ASU, we defer revenue recognition unless cash collection is probable, but there's no installment method or cost recovery methods anymore in terms of revenue recognition. Third off, what are the criteria for recognizing revenue over time? Well, it depends on the earnings process in current, in previous GAAP. So for long-term contracts, you'd be recognizing revenue over time generally, unless you didn't meet the criteria for percentage of completion. Under the ASU, you've got these 3 criteria for determining whether you can recognize revenue over time. Just one more page of this, and then I'll stop. A few other, I think, important things to understand about changes between previous and new GAAP. accounting for multiple performance obligations, here it depends on the industry. And you know, one way to think about current GAAP, what we're used to is, depends on the industry is a pretty common thing that people say. There are all these industry-specific kind of siloed revenue recognition standards. So, you know, sometimes you'd ignore performance obligations. So, you know, like with cell phone providers or cell phone access companies, they give you a free phone. Sometimes revenue recognition is constrained, like software, where you don't have vendor-specific objective evidence. Under the new ASU, you know, industry doesn't matter anymore. We apply the criteria for determining whether or not goods or services are distinct, and figure out what our separate performance obligations are, and then recognize revenue when each is satisfied. And this is a big difference, and it's going to really depend on the contract. But you can imagine a situation where you know, a cable company gives free access to HBO for a while, or installs a DVR player in your house, and that's, you know, included in your bill. Well, now they're going to have to figure out which of these qualify as separate performance obligations and bust up their revenue recognition and recognize it appropriately for each of them. So any time where someone has a customer incentive now, where they're giving them an option to get future goods at a lower price, or they're giving something in quotes free, where currently we often just treat that as a cost, we don't recognize revenue separately for it. In this new world, there's going to be a lot more of viewing these as different separate performance obligations and accounting for them accordingly. And like I just said, treatment of customer options for additional goods and services, you know, again, it depends on the industry. Sometimes we break these out as separable deliverables, like software upgrades. Other times we ignore them. We're used to thinking about whether or not we should accrue a cost for frequent flyer miles. Well, we normally don't think about recognizing revenue associated with frequent flyer miles. But if we think of that as a material right that we're giving the customer that they wouldn't have otherwise, we might have to set aside a little bit of each plane ticket as deferred revenue and recognize that revenue when those frequent flyer miles are used or when they expire. That's the kind of thing that this busting apart contracts into separate performance obligations, that's some of the complexity that it adds. Treatment of variable consideration, we spent a lot of time on that. We're used to not recognizing contingent gains until that contingency's been satisfied. Here, we're going to include estimated variable consideration, the transaction price, but only to the extent that it's probable that a significant revenue reversal won't occur. And then finally, something we didn't talk about, but that's kind of interesting, is treatment of time value of money. We're used to, with long-term receivables, imputing some interest and recognizing then some interest revenue over the course of the contract. The idea is the seller isn't going to loan money for free, so part of the price that they're getting in 2 years or whatever must be interest revenue, and so we break that out by imputing it. And what this ASU says is, well, what about an advance prepayment? What if the seller is paid a year in advance? Shouldn't symmetry apply? Shouldn't the seller be forced to recognize some interest expense for that? And so the contract requires that if these kinds of time value of money considerations are important, significant. And that is that for some key highlights of things that have changed under the ASU compared to what we're used to seeing. And that takes me to the end of my prepared remarks. I'm hoping that you're still in whatever room you started this in, as opposed to abandoned me partway through. I hope you've gotten something out of this. We're excited about the work that we've done on the chapter. We're excited to be hopefully helping people with teaching their students this new revenue recognition standard.